Hi, I'm Ashley with Campbell. Thanks for investing your time to help your community be a great place to live. Before you watch the video, make sure to click the subscribe button so that we can help you make educated decisions as a board member.
Thank you, Ashley. Good afternoon, everyone. My name is Evan Bradley. I am the Chief Financial Officer for Campbell Property Management, one of the 5 owners of the company. I'm also a licensed CAM, and I work very closely with some of our largest clients on the major issues they face in their associations. And one of those, particularly over the last 5 years or so, has been insurance. For those of you who may not be as familiar with Campbell, we've been in business since 1953. We currently manage over 400 HOA and condominium association clients exclusively here in South Florida, which is Dade, Broward, Palm Beach, Martin, and St. Lucie counties. Our guest speakers with us today, we have Chad Tiernan and Paul Mack of Mack Waltz Insurance Group. They are experts and specialize exclusively in condominium and HOA insurance. So they have a really strong feel for what's going on in the market, what the trends are, and what are some things you guys can be doing to maybe help reduce rates or secure the best rate for your association. So Paul, Chad, would you guys like to introduce yourselves and your firm a little bit?
Evan, thanks for having us again. It's always great to be here with you. Yeah, so we specialize in writing community associations. We've been doing this for over 30 years. We have over 3,000 communities that we insure throughout Florida, and having a deep expertise in this space really helps us make sure that our clients have the best possible program that's out there.
Right.
Yep. Really appreciate you having us on, Evan. Looking forward to getting into some of the topics we got planned for today.
Okay. Thank you, guys. So getting into our agenda, we're going to try to cover some of the basics of association insurance. Your insurance agent is different from some of your other vendors, and it's important to explain how this process actually works, what you should expect in terms of what type of association you are and what renewals are looking like. We're all dealing with these potentials for mandatory roof replacements. We'll talk about that a little bit. General liability is an area that's changed a lot over the last few years, and it's important to know what's going on there. There's a new policy we haven't talked much about before. I should say relatively new. It's been around for a little bit, but we really want to highlight it given some of the things that are happening in the marketplace. That's called a legal gap policy. We'll talk about electrical panels. There's some flood map changes. Everyone wants to know what can be done to reduce rates, and then how do you communicate all this to your owners. So, Paul, Chad, let's just start off with what are the types of insurance that the association must carry?
Yeah, so there is a difference between a condo and an HOA. And we're going to try and be specific because we know that there's a split between the viewers. Many of you are involved in a HOA, and some of you are involved in a condominium association. But the basic policies that either a condo or an HOA carry are really broken down into 5 or 6 areas. So we see a property insurance policy that an association carries to cover the improvements. And if you're a condominium, it's generally the residential building or buildings that are there. And in an HOA, it might be different type of improvements like entry features and clubhouses and things like that. But nonetheless, there's still improvements that need to be insured for perils such as fire and lightning and windstorm and perils of that nature. So we see that property policy. And then there are some other policies that we write to protect those improvements in addition to fire and lightning and wind, such as equipment breakdown. So we have in a condominium, cooling towers and fire alarm systems that are subject to equipment breakdown, sudden and accidental mechanical breakdown of the equipment. And in an HOA, you might see some other type of mechanical breakdown for other types of equipment like irrigation systems and other things like that. So those are the first party policies that we write for a community. And then we have third party exposures where the association can be sued for things like trip and fall. And that's written under a general liability policy that condos and HOAs have. Directors and officers insurance is another really important coverage, and oftentimes now we're getting into the smaller premiums, and sometimes these policies are overlooked when you have to get down to some of the details. But it's very important that the directors and officers policy is very broad and protects all of the D's and O's and any volunteer that's involved in the community association. And that's really management malpractice for its simple definition. And then we have a crime or fidelity policy that is required by condo and HOA statute. It's supposed to represent all of the funds that the association has. We would include operating funds, reserve funds that are in place. And this is bonded by an insurance company in case it's stolen internally, or by a management company, or by a third party. So very inexpensive to insure, but an important piece. We also have an umbrella policy. An umbrella policy is really catastrophic exposure. So God forbid there's a wrongful death or some serious type of incident that occurs, the liability slip and fall will only cover up to $1 million per occurrence. And then we buy an umbrella to get catastrophic limits up to 10, 15, $20 million. So that's an important, very important component to an association's program.
Thanks, Paul. So we've had some people ask, particularly now that rates have gone up, can they be self-insured? What's the answer to that?
Yeah. The answer is it's not practical. It comes up all the time. There's several reasons it's not practical. I'd say first and foremost is bylaws require that the association buy insurance, and you wouldn't want to go against what the bylaws say as a director, an officer of the association. You're required to do something. You should carry it out. And then practically speaking, there's no lender that's going to accept this. So anybody trying to close a loan in the condo is the lenders are not going to accept self-insurance. And self-insurance is a real thing where you're gauging risk, you're funding for it, you're anticipating claims, you're hiring claims administrators. And really what I think associations want to do is just go bare and not buy insurance.
Right.
Also creates a tremendous exposure for the board of directors. If there is a loss that could have been insured, your directors and officers liability policy is not going to pick up that exposure. So it also creates a big risk for the officers.
Right. And I've heard some attorneys say that they could be potentially personally liable if they're intentionally going against the requirements of the docs. So something to be very careful with.
Yeah.
So kind of questions 2 and 3 are pretty similar. What is the role of an agent, and how does the agent shop or bid out insurance?
Yeah.
It's a really common confusion.
It is great issue to discuss, because what I think it's important for everybody to understand that's on this call is that the agent doesn't do the bidding. The insurance companies are the ones that are actually bidding. As agents, what we are going to do is collect all the data, put it in a format that the insurance company can evaluate and decide whether or not they want to give a quote. So the agent's role is very, very important in that process, because putting that data together, negotiating with the insurance companies, and having the expertise and the knowledge and the contacts is really where the rubber meets the road. And there's a big difference between agents. So my recommendation is you choose an agent that really understands community association, could give you the proper advice and counsel when you're looking at it and you're evaluating the bids that come in from the insurance companies. Because again, we don't bid, the insurance companies do. And we're going to get into this, but the marketplace has gotten a lot better than it has in the last 2 years. So now we're actually seeing real companies and bids, and we have those options. So the importance of having an agent that can bring those carriers that have capacity to the table and can leverage the association's position the best way possible, which is going to produce competitive rates, good coverage, and then the other real value that we bring is because we have such a deep expertise in the space, we can help associations make the best buying decision that they can and help them. It's very complicated, and we're going to get into some of these exclusions and the way this works, and having somebody you can trust that's going to help and guide you through this process is I think the greatest value.
Right. So yeah, you kind of talked about it. How do they know that they're, a lot of people say, well, how do I know I'm getting a good deal? I can only work with one agent at a time. How does that work?
Yeah. So the insurance companies are only going to accept one submission. So as I mentioned, the agent's role is to collect the data, put it together so that the insurance companies can make an evaluation. And once they get that information from an agent, if another agent comes in because an association wants to get multiple bids, that second agent is going to be locked out. And that's the reason why you have to choose an agent. And the companies are doing the bidding. So you want to choose an agent that can bring the greatest value to the association, that has all the companies that are going to bid, that's going to be able to put the information together, that's going to be able to leverage the marketplace and get the best deal that's out there. So how you know that you get the best deal is you go through the process of interviewing agents that you think are going to do the best job for you.
Okay. So there's a couple of terms that get tossed around all the time that are really important that I think a lot of people don't understand the meaning of. It took me a long time to really gather it. So when you guys say we have an admitted carrier and then you say we have a non-admitted carrier that might be bidding on the insurance, what does admitted versus non-admitted actually mean?
There's two big differences between admitted and non-admitted, and what I think is important for everybody on this call to understand is admitted carriers have a higher degree of regulation by the state of Florida, by the Department of Insurance. And by higher degree of regulation, I mean that they can't change rates, they can't put exclusions, they can't manuscript endorsements that limit or restrict the coverage without the approval of the Department of Insurance. So it's a higher degree of protection for a consumer to deal with an admitted carrier. And the non-admitted carriers, conversely, they don't have to do that. And the logic behind that is those carriers are there as a backup. When we can't get insurance in the standard or admitted market, we go to the non-admitted market, and those carriers need a little more flexibility because in theory, they're taking on risk that's higher. There's a reason you're dealing with a non-admitted carrier. Florida is very unique because of the catastrophic exposure that it poses, that risk to an insurance company. So we always see a good blend of admitted and non-admitted carriers. And the other big difference between an admitted and a non-admitted carrier is the guarantee fund. So we have what's called FIGA, which is the Florida Insurance Guarantee Association, and it will provide a backstop for an insurance company that goes insolvent. You have unearned premiums, you have unpaid claims, and that is going to be backed up by the state of Florida, depending upon the policy, how much you get. But you do have a protection for credit there if the company goes insolvent.
All right. Another term that gets tossed around a lot is surplus lines. This is a surplus lines carrier, and it means a lot to you guys, but maybe not as much to our board members. So help them with that one.
Yep. So surplus lines is another way of saying a non-admitted carrier, and a standard carrier is another way of saying admitted carrier, but they really are one and the same. So it's important for everybody to understand that in Florida, it is very common to have to use non-admitted carriers on both property and on liability insurance. On liability insurance, it's almost exclusive. I mean, there are a couple of admitted carriers that write in Florida, but I would say the majority is written on non-admitted paper. And it's okay because you almost have to in some cases. But again, going back to the value of an agent, the agent's job is to vet the policy and the exclusions and the limitations very carefully, because they are going to be in a non-admitted carrier all the time. They don't have to get these forms and exclusions approved by the Department of Insurance before they write. And oftentimes they throw things in there. And it's very, very important that you, the policyholder, understand the difference, because there's a big difference between prices. We could see prices of $200-300 per door for general liability, and and then see prices of $500-600 a door, but there's significant limitations, which we'll get into here, things that it's important that you're aware of.
Thanks, guys. So I think probably the most common question in our registration is what's happening with rates? What should we expect in 25? Should we expect a decrease? Do we have more carriers, that sort of thing? So I know we've got another slide that gets into some detail, but is there a chance you might see some decreases this year?
Yeah, this is refreshing to be on here and, not going, boy, the market's really bad. I've been doing this 30 years. The last 2 years were like nothing I've ever seen before. And for a lot of reasons, which really quick summary of that, we went through this horrible period the last 2 years because we had the Surfside collapse, we had back-to-back active hurricane years, and we had a very difficult legislative environment that allowed policyholders to sue their insurance company, and the insurance company had to pay both parties legal fees. And it created a situation where 9 insurance companies went bankrupt, and we had very little or no capacity writing and simple supply and demand. We had much more demand than supply, and rates skyrocketed. So that has kind of settled down. They did make some changes in Tallahassee and got under control the free roof syndrome, I'll call it. And we've attracted a lot more capacity in the market and simple supply and demand. We've got a lot more supply than we had, so we're seeing rates that are stabilizing. And we're going to get into really trying to find ways that an association can evaluate where they are, because we're seeing rate decreases all over the board. Some rate decreases are pretty modest, where we'll say 5-10%, but we're seeing some that are really dramatic, up to 50-60%. And I want to get into, which I think we have some more slides on that, will help associations to really evaluate their situation and what they can expect.
So are we seeing carriers now, new carriers in the marketplace now?
We are. And we're also seeing the really established carriers that are in the marketplace having more capacity. So carriers that, some people here may be familiar with that they've seen in their program, like Heritage, like American Coastal, like Frontline, carriers that have been around for a few years. Well, going back 2 years, they couldn't write anything because they buy reinsurance, which is insurance for the insurance company, and they didn't have any capacity to write. Well, now their coffers are full with reinsurance, and they've got more capacity and ability to write. And the old stable markets are out there writing, where when they weren't, it was creating a problem. And we have new capacity, we have new carriers that are coming into the market. So it's allowing us to give our clients more options, which is
That's great. Finally, some good news after doing this for about 5 years now. So that's great.
Hallelujah.
Yeah.
So I know we have a lot of different types of board members on. I mean, from different types of communities, I should say. We have some beachfront high-rise people. I'm sure we have some mid-rise and garden style type communities that might be west of 95 or even west of the Turnpike. And then we have homeowners associations on with us today. So why don't you kind of get into each product type and talk a little bit about what is happening to them?
Yeah, I think that was one of the things that we really wanted to do for this webinar, is break it out into different community types and let you know what you should expect based on your community type, rather than just giving you kind of a general market update. So we'll start, with the beachfront high-rise condos. These are still difficult to place in terms of there's not that many admitted carriers, or if any admitted carriers, that will write for these types of communities. But the good news is we're still seeing decreases from the carriers that do write them. With a lot of these communities, you're going to be looking at those non-standard surplus lines carriers, and the admitted market is pretty hard to get for some of these bigger schedules. And the reason is just because the replacement cost value on these is much higher than some of the other communities. So the carriers need a lot of capacity to be able to take on these buildings. One of the big things that we've seen with them is the 40 and 50 year recertification has been huge. So if you're done with your 40-year or 50-year recertification, you should be in a really good spot in terms of getting a decrease. And then having a new roof is another big thing. So that's one of the things that carriers have really started to look at the past couple of years, and it's become a big deal. So regardless, you should probably be seeing a flat renewal to a single digit decrease. If you're still working on your 40-year recert and you might have an old roof, but if you've done your 40 and 50-year recertification and you have an old roof, you might be a little higher, maybe a 10 to 15%. And then if you've got a new roof, there's a lot of ability to get a much better deal. And we've been seeing decreases of over 25%. One of the things that's really important to note when talking about decreases and percentage and what to expect is that each insurance policy, each property policy has a rate, and that's basically how we as insurance agents can evaluate where you stand in the market. So we can look at the rate and say, this is way overvalued compared to what we're seeing in the market. And if you're in a scenario where your rate is extremely inflated because over the past couple of years, you've gotten huge increases and the premium has skyrocketed, you could be in line for a bigger decrease than maybe another community that hasn't seen those massive increases over the past couple of years. So really, in terms of what your specific decrease or rate change should be, it depends what your current rate is at. And you should get a third opinion or a second opinion on where your rate is at and how much it could potentially go down. We can do that if you feel free to reach out to us, or any other agent should be able to give you a second opinion on, hey, this is where we think your rate stands right now, and this is where we think it should go. But we are trying to give you at least a little bit of idea from a general sense on what we're seeing on average. For mid-rise condos and the garden style communities, there's a lot more carriers that will write for these communities. Some of the admitted options like American Coastal, Heritage, Frontline, they are in play for these types of communities. And that gives us a little more leverage and freedom to be able to negotiate better deals. If they're right near the coast, there are a couple carriers maybe that wouldn't apply. So Heritage, for example, is one that they're pretty strict along the coast. And even if you're a low-rise garden style community, if you're right near the coast, they may not consider. But there are other admitted carriers that will. And then the 40 and 50-year recertification is huge with these as well. If you have that and you're done with that, or you're well through the progress of it before your renewal, then you should be looking pretty good in terms of getting at least a double-digit decrease. And that's just what we're seeing on average. Homeowners associations and property owners associations, a little different, as we kind of talked about. We're trying to apply this to every type of community that might be listening. You might be a homeowners association with a big clubhouse where you do have a bunch of property exposure. And in that case, I would say you'd probably fall into similar to the garden style and mid-rise condos. You should have a good number of admitted carriers in play, and then the non-admitted markets will be an option as well. And if you have a new roof, you're going to be in a really good spot. But if you're a homeowners association or property owners association with very few property exposure, it's probably just going to be your swimming pool, or if you have tennis courts, or even if you just have some signage and lighting. There's not as much property exposure there. And if you have just some of those things, then the non-admitted markets are really going to be the only carriers they're going to offer. But you should still be seeing, about a flat to a single-digit decrease for some of those low schedules. And And that was a lot of information. And this is one of the bigger topics, but definitely if you're interested in seeing where your specific rate stands compared to what we see in the market, feel free to reach out and we can take a look and let you know. But that's kind of what we're seeing on an average basis.
Yeah, and I think it's important to know too, because this is where we got into that before, where you said, well, we can only deal with one agent. We can do an evaluation, like Chad had mentioned, without having to sign an agent of record and make a commitment. You do that when you're impressed with what you see and you decide you want to engage that agent because that agent can bring a lot of value to the table. But to go in there and do an assessment, like Chad mentions, that's the most important thing is what's the starting point? Where are we at now? If you had an old roof, your last renewal, and your rate's $2 per 100, you're going to see a huge decrease. And that an agent can, if you're dealing with an agent that knows this space well, and we can sniff that out pretty quick and give you a really good idea what to expect without having to make a commitment at that point in time. So it gives people the feeling that, hey, you've got options and you can talk to other people without having to sign it away at that point.
Okay. Thanks, Paul. Thanks, Chad. So the most annoying, controversial topic at the moment is probably mandatory roof replacements, particularly for our condominium customers, co-op customers as well. I know we have a few of them on. So what, I guess, why do these insurance companies care so much about how old the roof is, even though it's not leaking? And then what are you seeing in terms of replacements?
Yeah, so the main reason that the insurance companies care about the roof age, regardless of if it's leaking and it's a perfectly fine roof, is that they see when it gets up there in age, it's more susceptible to being ripped off during a windstorm, during a hurricane. And then that's where there's just a ton of exposure into the inside of the building and different parts of the building getting damaged. So in terms of the age, they're really concerned about that it's more susceptible to being ripped off rather than it could be a perfectly fine roof that doesn't leak. So it'd be perfectly fine in that sense, but yeah, that's the main concern.
Yep. Yeah. And I mean, what typically happens is it's a gray area. So we have a hurricane and an old roof. The insurance company goes in and says, well, this roof was old before the storm, and a policyholder can bring in a public adjuster, and an adjuster can bring in an expert that said, no, the roof's damaged. So that's where the insurance company has more risk to being sued, and that whole free roof syndrome that we went through years ago. So it's less desirable. And insurance companies have put very penalizing endorsements or limitations on older roof buildings where you're not going to get replacement value. You're going to get actual cash value. The difference is the depreciation. There's a big difference. Replacement value is new for old. Actual cash value is old for old. So that's a clause that protects the insurance company, because after you apply a very large deductible for a hurricane to this, and then you depreciate the roof on top of it, it effectively makes your roof uninsured.
So some people have said, well, can I extend it if I get an inspection, maybe by an engineer or by someone else who's qualified? Is there any way I can not get canceled if I have a 20 or 21-year-old roof?
The short answer is no. Citizens did give a little rope on that, and they said, okay, if you're going to replace it, let's see a contract. And, that all went away. So it's a pretty hard and fast no, especially now. Here we sit in April going into hurricane season. So if the association's intent now is to replace the roof, the insurance companies are going to want to see it done before they're going to take the risk. And I mean, everything's negotiable, but that's a pretty hard position that we see right now.
And then what happens if they do get one of those non-renewal or cancellation notices? What should they do?
Yeah, I mean, you're going to be in a position where you're not going to have a lot of options. You're probably going to be looking at a higher rate. And you're almost definitely going to be looking at that actual cash value for the roof instead of replacement value. As I indicated, it'll factor in depreciation. So after you pay the deductible, they're going to depreciate the roof, and if it's old, there's going to be a heavy deduction for that. Some associations, especially coming out of hurricane season, because the other thing that we didn't mention here is when you buy a wind policy, generally, particularly with a non-admitted carrier, there's going to be an accelerated earned premium clause. And by that, I mean, you write this policy, it's a big premium, it doesn't give you a whole lot of coverage. And the minute that policy is in effect one day during hurricane season, June 1st, it accelerates the amount of earned premium. So if you wanted to cancel it after you got a new roof and rewrite it and renegotiate terms or go find another insurance company, the insurance company's not going to give you any money back. So you've got to be aware of those accelerated earned premium clauses. So some associations have elected to say, well, look, why pay this tremendous premium for a wind policy that's fully earned and doesn't give us a whole lot of coverage? There's a risk associated with it, but some associations have said, let's buy fire, lightning, let's buy property insurance, exclude wind, get the roof replaced, and then buy the wind insurance. And that's been a fairly common practice. Now we're coming into hurricane season, so there's a little more risk there if you're in that situation where you've just been canceled and you don't have a new roof yet.
A couple of people in the Q&A and in the registration are asking, are all roof styles looked at the same? In other words, tile, asphalt, metal, do they all have the same useful life, or are some allowed to last longer than others by the insurance company?
Some are looked at differently, but what's important when it comes down to modeling is that the roof covering, whether it be shingle, tile, or metal, has been taken off and has been replaced down to the roof deck. So, and then you have different types of roof deck, right? You've got a pitched roof that's wood, or you've got a light concrete, and then you've got some sort of bituminum or something that's on that. So they're going to want to, and then all these things have different useful lives. Shingle and tile have longer useful lives than a flat concrete roof deck does, because water's going to sit on that and wear that out quicker. Those are generally 15 years, where your tile and your shingle are more like 20 plus years.
Mm-hmm. All right. So moving on from roofs, another major policy everybody carries is the general liability policy. And this market has gotten very tight recently due to all the litigation. So talk a little bit about what is general liability insurance, and then what's happening with these exclusions.
Yeah, so we've already talked about the property market a little bit. We wanted to spend some time on the general liability market, which affects everybody, regardless of what type of community you are. Most of you, if not all of you, should be holding general liability insurance. And one of the common things we see is these exclusions and limitations that they put on the policies. And kind of like we talked about before, a lot of the general liability carriers in Florida are surplus lines or non-admitted markets. So they have less regulation from the state, and they're able to slap some of these exclusions and limitations on a little more easily than the admitted carriers. So you really want to be aware of what's in the fine print on the policy, so you know where your exposure lies. So we have a few listed up there on the screen. A couple of the concerning ones: an animal bite or animal exclusion. If you have pets in your community, if you're a homeowners association that you have homeowners that have dogs or any animal, you should check to make sure you don't have this exclusion. If you do, you can either move to a different insurance carrier that might not have it on there, or sometimes you can submit a pet policy that's in your bylaws, stating a weight limit and that type of thing, to be able to get it removed. That's definitely something. If it's in there and you have that exposure, reach out to your agent and see what you can do. about getting that removed or moving to a different carrier. Assault and battery is really any type of physical altercation. If people got into a fight on the parking lot or in your community, and there was a lawsuit, they're going to try and drag in your association and the management company, everybody involved, just because it happened on the property. And if you have an assault and battery exclusion in the policy, you're not going to have coverage for that. And that can typically be, all of these can typically be a very costly claim to deal with. So it's very important to check firearms, any type of gun or any other firearm. If there was an incident that involved that and there was a lawsuit and you had this exclusion, it wouldn't be present. There would not be coverage. And then abuse and molestation is really sexual harassment and sexual abuse is what that's referring to. So they're serious things that, you know, you may not think would happen, but when they do, they can be very costly and can be a big problem. So you want to make sure you're looking at the fine print in the policies.
Those four represent very severe potential claims. I mean, we could do a whole seminar on some of the other exclusions that we haven't mentioned on here, but I think this is a part that your agent has tremendous value, because your agent can go in there, and in some cases, a lot of these exclusions can be removed by just asking. And if you can't get them removed, then we find other solutions. We write standalone policies for some of these exposures. We'll talk about the legal gap and how that can fill in some of the gaps of exposures that you have. But having an agent that understands this space can find some solutions, or at least be able to say, this is what we have. We've got other solutions that are more money. If you want to take the risk and have these exclusions on here, you're aware of this. You're going into this with both eyes open. You're making an informed decision on what's best for the community. And that's where you have this value of what we can do to help. I'd be very, very wary of a quote that I get from an agent that has no detail of exclusions or limitations or anything, and just has a really low price, because they may not be disclosing that there are some limitations, or the agent may not even know to look.
All right. I'm glad you guys brought this up, because we have seen claims in all of these areas at different HOAs and condominiums that we manage. And what happens if you're not insured, just so everyone understands, is you have no insurance, you have no defense coverage, which means you're going to have to pay out of the association's checkbook for every nickel of lawsuit defense. And in the event that you were to lose a lawsuit or had to settle one of these lawsuits, you're more likely to settle than to go to court. Any of those settlement costs would have to be paid out of the association's checkbook. And that could mean special assessments if you're not carrying the proper insurance. The reason these things are added as exclusions is because they're candidly too common. Every single one of you, whether you have allow pets or not per your documents, has pets in your community due to the emotional support animals issues that we're all aware of. And you might think, well, you know, no one on my board is going to assault an owner, or, you know, no one's going to shoot anyone. I know my board members. That's not what some of these lawsuits arise from. It's not just the board. It's any incident that occurs on your property. So we've seen incidents at the tennis court, incidents at the security gate, incidents, between neighbors. And all of a sudden, the association ends up drawn into these lawsuits, not necessarily because you're the culprit, but because you have deep pockets. Even if you don't have insurance, you have the equity of all those homes in your neighborhood or condominiums in your condo as a source of revenue for a plaintiff, because you can special assess those owners. So people will come after you. So you really need to make sure you have the proper insurances in place.
Well said. And I can tell you, in my 30 years of experience, the lawsuits that I've seen settle for the multi-millions of dollars are in those four areas. And that's why they're excluded. Florida, Texas, and California lead the country in animal bites. Assault and battery and firearms, and that represents a severe exposure.
So warrants is a term that's not as common as exclusion. Could you explain what a warrant does and why that's so important?
Yeah, warrant it's another type of protection that the carrier might put on the policy to protect themselves. And it's basically it'd be a clause put on a policy that requires you to do certain things for coverage to be in effect. So typically a swimming pool warrant is a very common one where they'll have that in the policy in a clause stating that you need a dawn to dusk sign, you need properly marked depth markers, you need lighting around the pool, self-latching gate around the pool.
Works.
Yep, a list of things that you need to be present in order for there to be coverage. And these insurance carriers, when you write a new policy, especially with a new carrier, they come out and they'll do an inspection on the property just to make sure that everything that was told to them by the agent and the insured is true and accurate. So they'll check for some of these types of things. So if you have a warrant on there, you want to make sure that you have or are in compliance with what's in the clause, so that you don't run into any issues. Swimming pool is a big one.
Yep.
Are there any other
contractors that you use? They have to have insurance, and if they don't name you on their policy, and you have an indemnification agreement, some of these warrants are very, very limiting. You wouldn't even know how to comply with them, let alone know they exist. So they're very important that you at least know what they say, and if you can't negotiate them out, you at least got to know that you got to comply with them. That's another big one we see where, your landscaper has to have insurance and name you. All your vendors have to have that. So yeah, like I said, we could do a seminar on just this, but know that warrant is a way for the insurance company to wiggle out of paying a claim.
So not every, sometimes you have these exclusions or warrants, and other times there's just things that are uninsurable. Mold is one that's just universally excluded and you're never going to get it off. So if you have a claim that falls under one of these exclusions, what can they do?
Yeah, so we talked about there's certain circumstances where you can buy a standalone policy, like a standalone assault and battery policy. But if you can't get a standalone policy to cover a certain peril that you're not covered for, one option is a legal gap policy, which is basically just another layer of defense where if you have something that's specifically excluded in your policy, and you get sued for it, you have a claim, and your insurance carrier says we're not covering you for the legal fees for this because it's not included in your policy. If you have a legal gap policy, that's when it kicks in and will cover all the legal fees that are associated with that claim. And it's unlimited coverage. Typically, these claims don't go to a jury trial or anything. Typically, they get settled before that. But theoretically, if it did, it's unlimited defense coverage throughout that whole period. And it basically kicks in when you're not covered by something that's excluded on the policy.
So the expenses could be huge. I mean, defending anything in court, if you go to trial, is going to be a minimum of $50,000 to $100,000. Just minimum. Yeah. And if it's complicated and serious, it could well get into the 6 and even 7 figures. So what does one of these policies actually cost, though? I mean, that there's a huge range. So if you don't have this today, what should you add to your budget as a range?
Yeah, it really anywhere from about $1,500 or $1,000 up to a few $1,000s is really what it costs.
About $20 a door.
Yeah, about
plus or minus. Okay. It's pretty cheap, relatively speaking. You still have to pay the cost to settle it, but like you say, the legal fees can be very costly, and in some cases where the solution to buy a standalone policy is too expensive, this provides at least some protection.
Yeah, definitely something people should be considering, particularly if they have a lot of exclusions. So
that's right, and it's relatively cheap. It really is compared to what the solutions are to buying standalone firearms or weapons exclusions and buying, standalone animal bite or assault and battery coverage. This is really cheap.
Yep.
And one of the things that the people that created this policy wanted to do is their thing was they wanted to try and make it where if you're paying for this policy, you get value out of it, and you're essentially getting it for free. So one of the things that they offer, if you have this policy, you get 12 hours of free legal advice. They have a legal advice number basically you can call, and it's with an attorney group. So you'll have someone that specializes in working with community associations, and they will give you 12 hours of free legal advice. So if you just have one question, maybe you don't want to, pay your attorney for, or, some simple things, you can reach out and get this free legal advice. So that's one thing that they do offer that some people have found some good value in. We wanted to mention that.
Great. So aside from roofs, we hear a lot about electrical panels now. What are you guys seeing when it comes? This happens a lot on the condo side as it refers to electrical panels.
Yeah, this has come up in the past couple of years. There's certain brands of electrical panels that basically just been deemed unsafe and have been discontinued. And the insurance carriers have seen this and been stricter on their underwriting for some of these brands of panels. And they will either just not write a policy for it, or if they do an inspection and find it, they might require that you replace it or make plans to replace it. And FPE is Federal Pacific Electric. Stablock is one of the main ones. This was put in place in 1950, between 1950 and 1980. Very popular around that time. And Zinsco is the other one, which is really more so in the 1970s. This was also rebranded to Sylvania or GTE Sylvania. So if your building was built around that time and you haven't checked your electrical panels, it could be a good idea to take a look and see if you have one of these brands, and then talk to your agent about what insurance options there are with these brands, because you don't want to run into a situation where you get inspected and now you're behind the ball trying to get these replaced, and it can be a very long process to get these replaced. Just getting the materials takes a long time. So definitely good to be aware of and make sure you know what type of panels you have.
Yeah. There's a lot of insurance companies now that are, the admitted carriers, like we talked about the difference between admitted and non-admitted, but those carriers can't put an exclusion on that policy. So like Chad says, they inspect and then they get off. But some of your non-admitted carriers now, we're seeing more and more where they're just going to throw an exclusion on there, and the exclusion is manuscript, which means they just write it in there. They don't need approval from the department, and it says all these panels that we've just identified in here, if there's a fire caused by that, we're not covering your fire loss. And they put that in there to protect themselves. So you gotta know that exists, and then if you have those panels in there and the carrier accepts you, you got to know that you might not be covered if there's a fire.
Yeah. Very concerning. So the details matter, everybody. The details matter.
The devil is in the details, Evan.
Yeah. So another thing that's been changing on us recently is flood maps. They made a big deal, I think it was a year and a half, 2 years ago, about changing the FEMA flood map. So how is that affecting us in Palm Beach County?
Yeah, so Broward did them about a year ago, and then shortly after, Palm Beach just changed their flood maps. So up on the screen, on the left, you've got a map of Palm Beach County and kind of showing where the affected areas are. As you can see, it's a lot of areas. Most of Palm Beach County is being affected here. And then on the right, it's a little table that shows you where the flood elevation is being increased versus decreased. And the vast majority of parcels and areas in Palm Beach County, the elevation is being increased. So this means that people are being moved potentially from a X zone, a low hazard zone, to a special flood hazard area. And that's generally where you may need to carry flood insurance. Lenders might require it if you're in a special flood hazard area. So if you're in Palm Beach County and you have an X zone right now and you haven't been required to carry flood insurance, it'd be a good idea to reach out to your current agent or any other agent, reach out to us, and we can let you know if you're in that area and if you might be in a special flood hazard area.
Appreciate that. Run a little low on time, so this is a key one. How do we reduce our rates? People want to know, can we make improvements to the building? What if anything we do to bring rates down?
Well, there's new capacity in the marketplace. So leveraging that capacity is key, making sure that the data that these insurance companies are looking at when they're evaluating your community is accurate, and it's putting you in that position. So, if you've updated your roof, if you've done your 40-year inspection, all the things that we talked about, it's important that data is presented to them in that way. And really leveraging this marketplace. Now we've got choices. So, maybe Citizens is not the best choice for us because they're the state-run pool but their rates are sometimes highly subsidized. So what I want to do for my clients is make sure I'm getting the best deal. I might have 3 bids, but Citizens is really cheap. So I'm going to leverage that. I'm going to use that low rate to try and get the prices down for the other carriers. And that'll work in this market because these carriers are now aggressive again. So taking advantage of that, and that's where, I hate to sound like a broken record, but having an agent that knows how to do that and knows how to position it and is going to get you the best deal. That's what is important. Not shotgunning this thing out to the market and having 3 agents bid on it. That's not doing you any good. Not doing you any justice.
So for our condominium clients, some of them may have windows where some of the windows have been replaced, some of them haven't. Maybe almost all the windows have been replaced. What can the building do to actually lower, get into a better pool and lower their rate in terms of upgrades?
Yeah, the roof is the biggest, Evan. We're seeing that has the greatest impact on modeling. Yeah, windows, if you're fully impact, there are markets that will say, we're only going to write if you can check all these boxes. And if you can check all those boxes and you've got that, and that puts you in a better position, now you've even got more capacity that's out there and more options. And if there's more options and lower rates, then you're just going to yield a better product.
Yeah, and even if you're already with your one property carrier, and if you don't have impact windows, you don't have those at all, you could see a rate decrease just for getting those of about 10 to 15% or so for being fully impact protected. But the thing is, the entire building needs to have impact protected. So every opening, whether it's a door or window, needs to be impact rated. But you do get a discount for that.
Yeah, that's great. And those of you a lot of you are probably saying, well, our owners are responsible for our windows. You should consult with your association counsel. There are things you can do. If you only have 1 or 2 holdout owners left in an older building, to maybe convince them that it's the right time to get those last windows replaced and get that full impact protection that Chad's talking about, because it does make a massive difference potentially.
Yep.
So the last thing before we get to the Q&A is, how do we communicate to our residents? I mean, the most important thing is talking to them early about your insurance policies, giving them an idea of what to expect. Waiting until the last possible second, right when you do the budget at the end of the year, is not the best time if you have information in advance. And be working with your professionals. Have them come, have Paul and Chad or whoever your agent is come talk to your community and answer the difficult questions about insurance. Why has it gone up so much? Why is it going down this year? What are the things we can do? What are the things we can't do? Why do we need an agent? Why do we, all the things that you guys ask us that are intelligent questions. The owners have the same questions, and they're probably not on today with us. So, let the professionals educate your owners, and it goes a lot easier for you. And at the end of the day, regardless of whether you go up 5 or 10% or go down 5 or 10% this year, keep in mind, for you and for all your owners, that condo insurance in particular is still a pretty good deal. When you look at what you pay as a condo owner to live on the beach on a per unit insurance basis, you are still dramatically less expensive than what a single family homeowner in the same location would end up paying to insure similar value, in that location. So By spreading that risk out across 100 or 1,000 owners, whatever you have in your unit, in your building, you're still coming out way ahead to be able to live where we live, and that's a big advantage. One thing I did forget to mention on the other slide before we move on, a lot of you HOA people on are probably saying, well, how can HOAs reduce their insurance rates? The biggest thing we see there is risk and claim avoidance. Once you have a claim on your HOA liability policy, your rates can double, triple, quadruple, or more, depending on the claim, the exposure, the reserve they set aside, all of that. Getting out in front of that, checking your sidewalks, checking your pool areas, checking your fencing, checking all the things that could lead to a potential claim if they're not in good order, if they're uneven, if you have trip hazards, whatever those might be. Make sure all those things are in top shape and that you can document that they have been inspected. There's companies that'll inspect your sidewalks, companies that can inspect your playground furniture, all the different areas that are a risk to you. Make sure that you do look at them, you document that you looked at them, and if you do find any deficiencies, you fix them as soon as possible. Those bills look high of 30, 40, 50 grand to fix trip hazards or playground equipment or whatever it might be. I promise you the increased premiums over the 3 to 5 year period that you have to deal with that claim are going to far, far exceed whatever you think is an expensive repair. So
Great
please
advice.
be diligent about that.
Great advice.
All right, we got a few minutes left, and Paul, Chad, if you guys have a little time, maybe we'll stay on a little longer because we went a little long today. You have quite a few questions in the chat, so I'll try to moderate that while, and if you guys could answer our poll, it's super helpful to us to get these poll results. We're constantly putting on these webinars and constantly trying to make them better for you guys. So the more feedback you give us, the better we can make it for you in the future. Let's see. Someone asked, does swimming pool equipment fall under that boiler machinery type policy you were talking about, Paul?
Yes. Yes, it does.
Okay. Another one that they didn't ask, but are lightning strikes covered under that policy? Because that's one I've seen before.
Electrical arcing is a lightning strike is a basic peril, so that's going to fall under your property policy. But we see sometimes that lightning strikes off premises, and the technology that's out there today, they can get the latitude and longitude pretty close to where it struck, and that causes an electrical arc. That's covered by mechanical breakdown.
Good to know. EV charging stations are a major issue along with other electric vehicles. Sticking with the charging stations for a second, does that have any, if you installed them in your community, does that have any impact on your property premiums?
No, it doesn't have a direct impact on the premiums. There's risk in everything. So if there is a fire or there is some sort of liability claim that results out of it, it wouldn't have happened before. To your point that you just made, having claims could put you in a position where, the premium ends up skyrocketing, but there isn't a direct charge because of a charging station.
Good to know. This is an area we didn't cover at all, and it's a really important question. It talks about liquor liability. So let me get to it again here. So what is the importance of host liquor liability if my condo or HOA has BYOB events at the clubhouse and those sort of things? How would they be covered? Are they covered under my GL or not?
Great question. So a standard liability policy has a liquor liability exclusion, and that exclusion applies if you're in the business of selling liquor, right? So if you have a host endorsement and you're not in the business, and I would define in the business as having a liquor license and charging for the liquor, then that host liquor endorsement will cover that incidental exposure. And if you're in a gray area where, some people bring it, they have events and they charge people, even though they don't have a license, and it's a gray area, there are some carriers that'll write a liquor liability policy for a minimal charge, say $500, $1,000. And if you're in that gray area, I just recommend you do that. And we've done that in the past. Great question.
Few people have asked this in different ways, but bottom line is, how do you select the best agent, or how do you know you're with a good agent?
Well, some of the factors that I mentioned is experience. How long has your agent been writing community associations? Is there a intricate knowledge of what the exposures are? Do they have the contacts with the carriers and those relationships that they can leverage to make sure you're getting the best deal? And do they understand what the business is, so that when you're evaluating quotes, they can explain everything to you so that you can make the best decision that you can make? And, those are the services that this boils down to, and that makes all the difference in the world between agents, because I can assure you, agents are all not created equally.
Certainly. So someone asked about exposure to an association pool when they don't have a lifeguard. So I guess just our associations insured for their pool areas, whether or not they have a lifeguard, and what are your thoughts on lifeguards in general?
Yeah, well, I mean, as Chad mentioned, there are pool warrants on there, and some of those pool warrants will say you have a lifeguard or you have these conditions that exist. So you've got to read those warrants, and you've got to know what's in that quote. And you, as a policyholder, shouldn't be doing that. That's something your agent should have a handle on.
Yeah. The warrant, some of them, I don't think we mentioned this one, but it might say that you need a swim at your own risk sign in place of a lifeguard. So that could be in a warrant, and that's something you should definitely check on.
Kind of going back to how do you know you have a good agent? If you're interviewing agents, maybe what are a few questions you might want to ask in this market?
Yeah, some of the things that I just covered. How long you've been doing this? What qualifications does your firm have? What value added services are you gonna bring us? How many community association clients do you have now? That'll give you some idea as to whether this person is really qualified to deal with some of these really complicated issues that we're discussing.
One good thing I'd also add that some agents provide is a marketing log, which shows which carriers you went to in the previous year, because that's a big thing. Boards have to show to their community that they're getting bids and that they're properly bidding out the insurance. So if you have this marketing log showing, hey, these are all the carriers we went to and this is the result, then that gives them that evidence for the community.
Yeah, very helpful. When we were talking about the 40 and 50-year certification, I think some people weren't as familiar with that, so I'll explain that from the management side. So the 40-year recertification, and then each 10 years after that, so 50, 60, 70, that's something that Dade and Broward County were doing prior to the milestone inspection legislation that came out. And that is a structural and electrical recertification of your building. An engineer had to come out, and then you had to turn that report in to either Dade or Broward County at that time when it was due. Now the milestone inspection has been put in place. So that's a statewide certification of the safety of your building. So everyone in the state has to certify their buildings are safe. The electrical inspection is not necessarily required everywhere, but the structural inspection is. And then it's varying by jurisdiction. So you really need to get with your management team, your attorney, your engineer to understand exactly what's required where you live. But those inspections are what we were referencing. We talked about 40 and 50-year certifications. Ordinance and law coverage. Someone said, can you help me understand what ordinance and law coverage is?
Good question. Something we didn't cover. So your property insurance policy that covers the buildings, going to cover, fire, lightning, and wind. So ordinance and law coverage. So let's take Surfside, for example. It's a horrible thing, but it's a good way to illustrate what that is. So when that building collapsed, the portion that remained standing there that wasn't damaged by the collapse isn't covered under a standard property policy because it wasn't damaged by the collapse. So now the ordinances require that they tear down the building and start over again. So part of law and ordinance, part A, is undamaged portion. So you're going to get coverage up to the building limit that you insure it for, which should be the full replacement value for the building portion that's undamaged. And then part B is going to be the cost of demolition. So you got to tear down that building. There's going to be a cost associated with that. And then part C, which is the most common type of law and ordinance claim we see, is the increased cost of construction. So you don't necessarily have to have an A or a B claim, a tear down, to have a C portion. what we see there is you have roof damage from a hurricane. And now you've got to comply with the new codes associated with the increased cost of construction, right? The roof coverings have to have longer nails or screws to tie down the roof covering and more often. So the cost of that roof is now 20% higher. That increased cost of construction is picked up in Part C.
Right. This has been a common one recently. There's been some well-publicized fires as a result of lithium batteries. Are insurance companies putting any restrictions on indoor storage of electric bikes and other, motor vehicles? There are all sorts of different types now that use these high-powered batteries.
Yeah. In very rare cases do we see that, but again, with these non-standard carriers, they can manuscript that stuff if they're concerned about it, and we are seeing these fires. These lithium batteries get wet, and you've seen these video surveillance cameras of them catching fire. So, and as you said previously, loss prevention is key. So communicating things to owners and making sure that that the property is protected and safe goes a long way.
So this is one I see a lot. This was a popular trend about 5-10 years ago, this foam roof system and these roof coverings. Someone saying, how do the insurance companies look at those?
Yeah. So that's a pretty common thing that has come up often, where you have these foam roofs, but as we said, if you spray that foam roof on top of an old roof covering, that's not going to help you at all. So it's that roof covering that they're looking at that's going to get damaged during a storm. And if you spray something on top of that, the carrier is going to look at when that roof covering was last replaced. So if you're doing it in lieu of a replacement, it's not going to help you. If you're going to spray it on top of a brand new roof covering, that's just going to be another way to prevent leaking. But it's not going to really generate a whole lot of credit in terms of the premium. You're going to get that from replacing the roof covering.
Right. We do have some people from Dade County, Martin, St. Lucie counties on. Do you know if they've updated the flood maps for those counties as well as Broward and Palm Beach?
I have not seen anything. I believe I checked for Daytona in Volusia County not too long ago, and I didn't see anything there. Not sure about Martin County, but that's something that we can definitely check if you want to reach out to us, and we can find out for you.
All right. Let's see here. I think that's about it. We've gone about 10 minutes over, and do want to be respectful of everybody's time. So thank you, everybody. I wish we could get to every single question, but it's just too hard we had over 300 people on today. So thank you so much for joining us. Hope it was educational. If you want to look at any of our future classes, campbellevents.org. That's campbellevents.org is where you can find those classes. We do also have links to prior classes that have been recorded, and we do special classes for condo, HOA, and even some co-ops there. So do register for those. Paul, Chad, any parting words for our guests today?
Well, we just hope that it was informative and people got some information out of this, and Chad and I are here to answer questions directly. If you think we can be of service, please reach out. And thanks again, Evan, for having us on.
Oh, thank you guys for joining us. It was great, and happy to hear rates are actually potentially decreasing for a change. Much needed relief, especially given all the other issues we now have facing our condominium associations. So good news. Thanks, guys. Have a good day, everybody.
Thank you.
Thank you.
Thanks for watching. For more great educational content, click the subscribe button now.